Hi, Steve Van Metre here, and welcome to your weekly economic update where I take about 30 minutes every Friday to try to make sense of markets that really don't make any sense. And like every Friday, we're going to answer your questions and talk macro. Today's topic is bonds are on the launch pad, and I'm probably one of the only few people that really get excited about bonds, let alone being on launch pad, but we're going to look at that. But first, we need to talk about the stock market. It's rallying on the worst data since the Great Depression, and this is leaving investors confused. But we are in a computer-traded market. 80% of this market is computer-traded, and most of those computers, they don't read the news, so they don't know unemployment claims are up. All they know is, hey, are stocks up? If yes, buy. Oh, they're up some more? If yes, buy more. Buy. Now, eventually, they do run out of steam. There's only so much money available in the markets to drive stock prices higher. And when they go up and run out of money, and we're going to look at the trading volume today on the S&P 500 to give you an idea of how to understand that, what happens is stocks run out of steam and they go down. Now, is this rally justified? Well, it would be if interest rates were going up, but they're going down. Although today I thought for sure they were going to break resistance today, support. I thought Treasury yields were going to break support today. They looked like they were breaking it. They were trying to break it. And then the Fed announced that they have to taper their quantitative easing program a little bit. And the market said, no, we better sell bonds, even though the Fed is still going to buy $15 billion worth of Treasury securities per day. On top of that, $10 billion of mortgage-backed securities per day. And what that equates to is $125 billion per week with 20 trading days in a month. That's around $500 billion a month of bond purchases. And you go, well, yeah, but they're tapering. They're tapering. Why? Because the banks are out of bonds. There's a bond shortage. I know it sounds dumb. How can there be a bond shortage with all this record amount of debt being issued? But there is. So normally you would think, taper is a sign that the Fed thinks everything's okay. In this case, they're tapering because they've been chewing up so much of the bank's inventory. They need the banks to be able to buy some. So it's really not that big of a deal. Plus, when you go back and look at quantitative easing 1, 2, and 3 from the Great Financial Crisis, what do you find? The biggest month of bond purchases was $60 billion. And back then, for those of you who remember, that was a lot. $500 billion a month is still a lot and a lot more. It's a little over 8 times the purchase. So as far as I'm concerned, the market had a little overreaction today, probably mostly the computer algorithms, but we'll look because it still sets up this huge move in bonds and the stock market really doesn't see it. Now let's get to your questions, which I'm committed to getting caught up sometime next week, completely dependent on how many questions you send me over the weekend, but we'll give it a shot. All right, when I was thinking about things you explain in your videos, I came up with a question I have for you about how retail investors sell at the bottom of bear markets. Yes, that's true. You've mentioned a few times that the reason for this is they can't take the pain anymore, so they sell. That is correct. American investors hate losing money. They're not very good at making it because they buy high and sell low, but when it goes down, they will sell. And number 2, they need the money to feed their families tomorrow. Absolutely correct. People do cash in their accounts because they have bills to pay. Now that governments are rolling out massive stimulus package. Now, this question must have come in from Canada, I'm guessing, because in Canada, they're sending people who are eligible $2,000 a month. Now, do you think that in this bear market, the potential reduction in investors that sell at the bottom to feed their families will be substantially reduced? No, I don't. If it is substantially reduced, do you think other economic measures the government is implementing will be more successful in propping up the markets? No. So you have to look at this. Since there are jobs that will be lost, their jobs are not coming back. That's the key. There are jobs that will not be back. And you can't put a price on that. And some people think this is temporary. They look at this coronavirus as literally as they being sick themselves. Hey, I got a cold or the flu or something. I'm out for a week. And I come back and I'm stronger than ever. And they think that's what's going to happen with the economy. No, it's not going to work that way. So like I said, American investors like to buy high and sell low, and they do it with stocks, homes, cars, everything. They always sell at the bottom. And the government's trying to do everything it can to prop asset prices up since the U.S. economy is financialized. You understand the U.S. economy is the stock market. When stocks go up, people feel good and spend money. When stocks go down, they feel bad and can't. Well, right now, no one can really spend any money, so it doesn't really matter. But that is the psychological effect of the markets on spending. And this is why President Trump over the years has pumped the market. He knows, or someone he knows. Doesn't matter if he knows it or not, he does now. And he knows you've got to get stocks up to get spending up. And so I don't think it's going to work because the money being sent out for most people isn't enough. I mean, the data says it's going to cover food, shelter, and utilities. It's not covering car payments, credit card payments, other bills that need to be paid. It's not going to cover that, and it's not indefinite. People are not getting a $1,200 stimulus check every month. They're getting one. And that's the problem with our financial system that a lot of people don't understand. Why is President Trump so eager to get people back to work, get the states reopened? Doesn't he realize that this could, or a premature return to work, cause a second wave of infections? Yeah. In fact, he said, the American economy wasn't meant to stay at home. Let me rephrase that. A debt-based economy with a record level of debt is not going to keep functioning if we don't go back to work. See, debt-based economies were meant to get you to go to work because there's never enough money. I mean, if everybody in the world tried to pay off their debts, because the whole world is effectively on a debt-based system, there isn't enough money. It's like musical chairs. Somebody's not going to have a chair. Well, lots of people aren't going to have chairs. So debt-based economies collapse when people aren't working and paying on their debts and making new loans, taking out new debt. The whole financial system collapses, the monetary system collapses, and the federal government cannot borrow enough money to prop this thing up. It is not possible. So yes, I still think people will sell at the bottom. They always have, they always will. It won't change. It only means that the pain of how low the market's going to go to get them to sell is perhaps deeper than I think. Maybe I could be a little greedy and ask another question. Fair enough. From your last video, do you believe that inflation in CPI will go down? Yes, I do. Oh, you believe. Yes, I misread it. Yes, I believe inflation will go down. It's a lagging indicator. It will follow yields down. It will follow crude oil down, as you've seen. How does that affect things like U.S. government bond tips or Treasury inflation protected securities? They go down. Next question. Here's some questions for educational purposes. They're all for educational purposes. I know it's impossible to predict the direction of the market with 100% accuracy. Yes, that is impossible. But what indicators or resources do you use to give you to provide some guidance in which direction the market might be going, such as the S&P 500? Just curious what I look at. Treasury yields. The answer is Treasury yields, because when yields are going up, guess what? Stock prices, they need to go up. And when yields are going down, guess what? Stock prices, they got to go down. That's kind of what I look at. Same question for bond yields. What can we look at to give us some idea of which direction the bond yields are going? The Fed. That's all you need to know. You need to study monetary policy, study the Fed cycles. Really, it's all you need to know is that relationship between stock and bonds and what the Fed does. Would you mind sharing the different bond prices you have associated with ticker TLT? Oh, yeah, I meant to have that ready to go, but I forgot. So let's load up where I go, and I will show you. Now, this is investing.com. There is a free cell phone app, and I go under bonds and 30-year T-bond. Now, TLT is a 20-plus year Treasury fund, meaning it pretty much only owns 30-year bonds because there's nothing over 10-year and notes. That's it. There's just 30 years. So this only owns 30 years, but the maturity could be between 20 and 30 years. This is what I look at right here. You can get on your cell phone totally free, and that hopefully will help you out a little bit. All right. Love the show. Hey, thanks. I appreciate that. I love doing it for you, so I'm glad you like it. Will it be better to refinance during the next leg down And bond yields over the next few weeks or months or in a few years for sure. Now, I actually wrote this question isn't new from, I think, last week. That's how far off I am in getting caught up. And I noted in a few years because banks are and will tighten lending standards. And lo and behold, JP Morgan Chase Bank tightened lending standards this week, making it difficult to refi now. Should be easier in years following the crash when banks are more likely to lend, but property prices will be lower. That's going to be a problem. Always is a problem. All right, next question. The risk of stagflation due to supply chain disruptions, which is where we would see inflation during a depression scenario, with interest rates and the dollar rising as in 1973 to 81, where the 10-year treasury got up to 14%. This could mean that the deflation scenario through QE, as we have seen thus far, grinds to a halt. Okay, that's an interesting argument. And a reversal would happen where interest rates go back up and people start saving again. The problem with that is people will want to save, but they have a lot of debt. In an environment of prolonged austerity. Okay, so here's my answer to this. Why did rates and inflation rise between 1973 and 81? We went off the gold standard. It wasn't a supply chain issue specifically. We went off the gold standard, and then you had this massive baby boom generation come into the economy and consume and demand and consumption, and that was what triggered it. So I don't see this happening again. All my data says QE is deflationary. The only way we're going to get inflation, we're going to get an inflation scare when all the smart money sells the bonds at some point and interest rates go up. But you look around the world. Have you seen anybody, Japan's been doing this for like 30 years or more. They don't have inflation. Europe doesn't have inflation. We don't have inflation. The only way we're going to get that is to somehow devalue the dollar. And that'll be interesting when we try to figure out how to do that. So no, we went off the gold standard and rates, and likely the dollar rose to absorb all the currency being created. That's what happened in 73 to 81. I don't think it had anything to do with supply chain disruptions. I mean, I'm sure that was a mitigating factor, but it wasn't the primary reason. The breakdown of the correlation between bonds, safe, and stocks risk assets between March 9th and 20th this past month created no safe haven scenario except for cash, which appears to have been caused by U.S. dollar liquidity crisis. That's true. And it caused the dollar to skyrocket. Has your model considered trading the U.S. currency as a third allocation type in case both bonds and stocks go down together, as we saw happening? I don't trade currencies, so the answer is no. If I did, I probably would. And this is where you kind of get into, okay, I'm gonna take the dollar, put it as a hedge in part of my portfolio. I'll give it a slice of my portfolio. Well, how big do you slice it? What's your, how do you determine what's called your sizing of your positions? Are you 90% treasuries? 8%. Stocks. I mean, I don't know. It depends on your allocation of what you're at. So how do you, size your trades? It's a good question. That would lead to how much dollar you are going to put in there. If I traded currencies, I'd consider it, but I don't. They just move too fast and can be unpredictable for me, which is my answer to the next question is, according to Rubini, this was backed up by the Fed's QE after, of course it was. Everybody knew the Fed had to react, and the market forced them into it. After which a correlation returned. It seems that we are at a complete mercy of the Fed. Of course we are. So why not buy the dollar and make a geopolitical bet? I don't do geopolitical bets. And like I said, currencies are just, I don't understand them enough. They can move for reasons I don't understand. And for that reason, I don't touch them. And if I did, they'd be such a small allocation. My portfolio wouldn't probably make a difference. Next question, the geopolitical risk and the setup for oil prices to skyrocket during a period of armed conflict with Iran and Saudi Arabia. I would assume this is priced in. This has got to always be a risk to oil. I really don't look at geopolitical risks. I mean, they're going to happen. From a macro lens, they're going to happen. I just don't know when, where, or why. I mean, last time we saw something like this, oil prices spiked and then they went right back down. So like I said, I assume the market prices this stuff in. In your last video, you expressed the perspective that markets haven't reached a bottom. No, I don't think they have. I just wanted to get your opinion on the below bull case for markets. Sure, i.e. the bear market has potential ended. I guess the question is, are you persuaded by any of the arguments below? All right, well, let's look at them. Technical indicators are showing extreme oversold conditions that have historically triggered bull markets. Here's the deal on oversold and overbought conditions. Overbought means the market thinks there's too many buyers. Oversold thinks there's too many sellers. In a bull market, which goes 10 years, how can you argue that over a 10-year period the market is not overbought? I mean, the markets can become overbought for much longer than you think. Same with oversold. They can also be oversold for much longer than you think. So no, the short-term effects of that don't really concern me. I'm really, as a long-only macro manager, I do concern myself with the bigger picture. I don't worry about the weekly and monthly and sometimes even yearly changes. It depends on how I am, positioned. Next question. Unemployment rates are at peak levels. When I got this question, that was a week ago, so the answer is no. Which have historically correlated market bottoms? Yes, that's true. No evidence that unemployment has peaked. None. Nor that everyone's going back to work. So will it come down at some point? Yes, maybe to a more normal level, but I don't think that it's a peak. Obviously, it wasn't when this question came in because we had the 5.25 million jobs lost last week. So, and there will be more next week. Some point they will slow down. Probably, I'm going to guess next week. Market is moving up despite bad news. Bad news appears to be priced in the markets. No, I think it's a computer traded market, and I know money managers out there have to play chase. I know retail investors are playing chase, and all of them are saying, how can the market be going up on bad news? It must be priced in. Well, it's because you're buying. I mean, if enough people buy, it doesn't matter what the news. Remember, the markets make the news, and news doesn't make the markets. The S&P 500 dividend yield has exceeded 30-year treasury yields. Probably not hard to do given how low yields are. Historically, the 3 times the 30-year treasury yields drop below the S&P 500 dividend yield. A bull market has been triggered. This is always an argument for stocks. If people buy them for dividends, I can tell you as an absolute fact. I hear something, I'm buying stocks for the dividend. Okay, now your stock is down 50%. Oh yeah, I need to sell that. And they do. Take a look at GE. Yeah, I don't know who sent me this question, but go look at GE. People bought GE for the dividend. And GE stock went way down. And guess what? They slashed the dividend. So dividends are not guarantees. If you're buying stocks for dividends, seriously, buy an annuity. I mean, at least you'll have your money, or most of it, when market goes down. But the key is, the problem is dividends do get cut in bear markets. I don't really look at this, so I don't have a strong opinion other than that. All right, couple more questions. I enjoy your tri-weekly macroeconomic updates. Thank you. It helps bring ideas to the table I may not have seen, like asset allocation propping up at the end of the first quarter in equities. Yep, that's good. I mean, that's what we're here to do. We're here to learn macro, learn what's going on that you might not see. And when do you think we will see the consequences of share buybacks on earnings reports? Oh, I like this question. My answer is quarter 2. I think we'll start to see it. And it just depends on how quick states can reopen and people can kind of get back to work. What's going to happen is we're going to see them on the earnings reports, but the market's going to ignore them. Maybe ignore them until Q3. Just how long the shutdown lasts, that's a big question. As a follow-up, will this create an immediate noticeable change in Q2 earnings, or will it be a lagging and downward sloping effect over multiple quarters? Irrespective of coronavirus and assuming the current state of share buybacks holds. My answer is change on quarter 2 earnings per share. I think there'll be a lagging and downward slowing effect over multiple quarters. It's kind of what I was thinking. And there's a lot we don't know that we're going to learn in Q1 here is who's canceling. I mean, we're going to start seeing as more earnings reports come out, who's dropping this stuff. We don't know yet. I'm going to assume that more than we know at this point are cutting those. So, all right, last set of questions. First, thank you very much for your great content. You're very welcome. I've learned a lot watching your videos, and I'm excited to read from your book list. Cool. Well, I'm glad you're learning. That's really awesome. I have been thinking about Fed actions. I think about Fed actions too much. So it's a problem of recession, one of money supply. Should the Fed increase rates to increase the money supply? Look, the problem isn't the money supply. That's the Fed's thought. Look, if it was as simple as expand the money supply, we've done that. It's really a shortage of dollars in the international market. So that's the problem is the Fed can ease they can pump dollars into the system. And what are they doing? They're pumping them into bank reserves. I mean, banks can't lend against it, so it's not getting out to the real economy. So expanding the money supply has done nothing. For example, say the Fed raced to 6% today. Whew, that would be crazy. We would suffer deflation. Oh, yes. And pain. Oh, more than you know. Until asset prices corrected. They would correct very quickly. But would the money supply increase at a greater clip? It would be more stable. No, the money supply would probably crash. See, rising rates is inflationary, but the problem is asset prices would crash. When they do, money gets destroyed. It would take some time for this to work through the system. Again, to me, the issue isn't the money supply, so I'm not sure how you're linking the two. Maybe if you want to clarify in another question. Again, there's always shortage of dollars in a debt-based economy that's by design to get you and me and a bunch of other people to go to work. So would raising the federal funds rate to 6% be the same as putting the economy on a diet? No, it would be like cutting off all his limbs and leaving it for dead. That's what it would be like. Okay, let's get into the data here and hit a few charts on our way out the door. All right, so looking at the asset liabilities of commercial banks. Why do we do it? We're in a debt-based economy. You got to look at the debt. So we see the securities and bank credit in terms of treasuries and mortgage-backed securities took quite a drop of about $34 billion last week. We know that the Fed has been aggressively buying. We know the banks are short bonds. This kind of tells us that. Normally, this would be a cause of concern, not with the Fed buying what it is. Now, loans and leases at all commercial banks were up just a mere $1 billion. But notice that commercial industrial loans were still up $24 billion. That's still substantial. Real estate loans were up $9 billion. Commercial real estate loans were up about $3 billion. So, wow, this was flat. But yeah, look what happened. I mean, you got to go to the consumer. Consumer loans dropped $17 billion, all pretty much coming out of credit card spending and a little bit out of automobile loans. Bad news for the consumer. So what you see in the data in terms of lending data isn't as important because the consumer is out. When the consumer is out, it doesn't matter what lending does. So the M2 money supply is growth rates up to 15.13% from a year ago. 6-month rate of change is rising. 3-month rate of change is rising, not having any effect on the economy. Where is this coming out of? It is, or into, the institutional money fund. So money is pouring into money market accounts. Hey, no wonder why there's a shortage of treasuries in the banking system, because money's flowing into money markets. And what do you need to back money markets? T-bills. Lots and lots of T-bills. All right, the monetary base is skyrocketing. Now, I'm so excited these are updated every week. So this is, I'm not putting a number here. It doesn't really matter yet. But the money multiplier is flat at 3.7. Now, I look back over here, and there's periods where it goes down, and then it holds and down and holds. So this little hold here is not a big deal. But this is deflation. And it's telling us deflation is coming, and it's still at $500 billion per month in QE, assuming this is where the floor is for now. This thing is going down. Remember, this went down at a peak of $60 billion per month. And it didn't even start that high. So this thing is headed down. Real estate loan growth is up slightly to 5.02%. The 6-month rate of change is flat. 3-month rate of change is up slightly. The commercial industrial lending is up to 22.71, but slowing down. The 6-month rate of change is flat. The 3-month rate of change is rising, but not much. But here's the key. Loans and leases, all commercial banks, growth rate is flat at 10.72%. 6-month rate of change is flat. 3-month rate of change is flat. All due to consumer loans, mainly out of credit cards, that are now down to 0.13% growth from a year ago. That's the economy. Goodbye. Put this thing to bed. If the consumers aren't spending, it doesn't matter. Any of this doesn't. None of it matters. So where are we at in the markets? Probably this, hey, we're back to normal, going to new all-time highs. And then the more is to follow. How do we know that? I think this is what I used to have the chart of the week, and this is definitely the chart of the week. If there was one again, this is it. The S&P 500 is now more concentrated in the 5 largest stocks than ever. Back at the peak of the dot-com bubble, if you owned Microsoft, GE, Cisco, Intel, and Walmart, and everyone did, you owned the 5 largest companies in the S&P 500, which had a market cap of 20% of the total index. Today, Microsoft, Apple, Amazon, Alphabet, and Facebook are at 22% of the index. So when you buy the S&P 500, 22% of your money is going into 5 stocks. This is a bubble. We know how this ended. And a big thank you to BofA Global Investment Strategy and Bloomberg for giving us that chart. All right, back over to the NASDAQ McClellan Summation Index. We see liquidity came in, and liquidity looks like it's starting to peak somewhere where it peaked and rolled over before. We'll see where this goes. I'm not overly optimistic. I'll show you why. And then the last chart I want to show you before we get into the trading platform is current new orders. This is the Fusion Index for the Texas Fed, and it's crashing because crude oil prices are crashing. And it tells us bad things are coming for Texas. There's going to be a lot more layoffs in the future, and there's going to come out of the energy sector. With crude oil sitting at 17 a barrel a day on what's called the front month contract, that'd be May, and at 25 on the June contract, there's no money to be made. No money to be made. All right, let's go on to the S&P 500's largest ETF, SPY. See how the price is rising here? Let's look at the raw index. It got up to this level of resistance now, going back over a year. If we zoom out, it's going back pretty much over a year, and it raced up here right to its 50-day moving average, a very technical move. Now, why would I say this is a technical move? Well, simple. If you overlay the S&P on Treasury yields, and let's go out a bit, and this, you can see the jaws are closing, they need to close. So you can see yields rising, stock prices rising. Yields are falling, stock prices are rising. One can only be right. They can be wrong for periods, but the jaws must close. So either yields need to go up or stock prices need to go down. It's possible that this rise here is a delayed reaction to this. It's possible. I don't know enough to tell you. I'll have to mull that over. It's possible. But I don't have an answer for you today. All I can tell you is that stock prices are more likely to go down than up. And if we look at something similar with crude oil, see, everyone's like, oh man, crude oil is cheap. It's so good for the economy. No, it's terrible for the economy. Because look, there's a decent relationship between the S&P 500 and crude prices. And look, crude prices are headed down, stock prices headed up. You do not get economic growth when oil companies are laying people off. You get economic growth when energy companies are spending massive amounts of money into the economy. I know some people on here don't like oil companies. I'll tell you, they spend a lot of money into economies, a ton of money. So let's look back on the S&P 500 ETF SPY. And so you can see prices rose on declining volume. Now, how do you interpret this, and what does this mean? So volume tells you what demand is. So let's put this in a way that we all can understand, because sometimes when I look at things like this and I don't understand them, what I need to do is relate them to something that does make sense to me. So let's use a movie, for example. Let's say there's a new movie coming out. It's a really hot title or whatever the story is, but it's in demand. And what happens? You go and there's a line, a massive line, and you stand in line and hope to get a seat, and maybe you do, maybe you don't. So if you don't, you go back the next day. And what if the line is shorter? And the day after that, the line is shorter. And the day after that, the line is shorter. What does it tell you? That this hit movie isn't resonating with the audience because they're going home and telling people, don't waste your time. Now, what if you went to a movie and there was no real line? And it was the best movie you'd seen in ages. You're like, man, there's no one here. The theater's empty. So you go home and tell your friends, you get online and tweet and Facebook and all that fun stuff. And next thing you know, the next day, there's a few more people there. And then more people there. And more people there, to the point where the theater's going, hey, we need to open up this film to more seats in our play. I don't even know what you call it, but they need to open more capacity. And there's still more demand and more demand and more demand. That's what you want to see, and that's what volume tells us. So when you have rising prices on declining volume, it tells you there is less interest here. Normally, you see markets the opposite. So let's go out, and you'll notice this entire 10-year rally is on declining volume. Less and less interest. But look at here. Previous bull market on rising volume. This is normal. Bull market here on rising volume. Not normal. And for this reason alone, it's possible, as people say, that this market could dip down to 1,200 to 1,500, where I've got these. I'll show you why in the volume, but I wanted you to see where I got the lines here. Why is that? Well, look where the last major bits of buying are at. Right in between here around, say, 12 to 1,500. Why? You get all this buying right here, and buying right here. After that, there's not a lot of buying. It's on a declining path. So it is very possible to see stock prices go down much further than most people think. Let's take a look at Treasury yields. I thought today we were going to crack through 1.2. Didn't get it. There was a late afternoon response to the Fed, which will not last. But let's take a look at TLT sitting on the launch pad here. Today, we'll zoom in to the 30-day, and we can see it got up, tried to break through the other day, and came back down. Today, got a little bit higher, and right toward the end, and we'll zoom in a bit more, right when the Fed announced was selling. And then what happened? Oh, found a bottom. What's key here is that it's making what's called a lower or higher low. So it's not going down as far. And when you do technical analysis where you try to interpret charts, what you're looking at here is what's called seller exhaustion, because we know the market's very short bonds. And at one point, will the sellers run out of ammunition, or they'll just say, hey, I'm done shorting, this market's not moving in my favor, especially when you have the Fed buying $35 billion a day in bonds. I mean, who is going to win this battle long term? It's pretty obvious who. So at some point, the sellers get exhausted, and then they're out of ammunition, and then off to the races, and then they have to unwind their shorts. And that's why I've got this purple line right up here. I thought today maybe would be the day we start to get through. Nope. But this doesn't tell me that the party's over. What it tells me is we're sitting on the launch pad, the engines are warming up, and the market just needs to get back up through there and squeeze everyone out. Let's take a quick look at the dollar. There's some interesting stuff going on there, and then we'll wrap up. So the dollar is in a consolidation pattern in this massive topping pattern. Now, how do consolidations patterns work? They either go higher or lower. There's no way to tell exactly, but we're in a dollar shortage. So to me, it tells me the dollar goes higher, breaks 103, and bad things happen in the market. Well, I'm Steven Van Metre. Appreciate you taking time to watch. We'll be back Monday to take a look at how the hedge fund managers are positioned, and let's hope they're even deeper in their bond shorts. I have a hunch that they are. I have a hunch, but we'll see. We'll get to more of your questions so I can get caught up and take a look at whatever's gone on in the macro world from over the weekend. Again, I'm Steven Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information and is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buyer selling security, financial product instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video are that of and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.